the computer. There we go. Before I forget. Awesome. So that is my goal today. My goal is to share an opportunity, and the opportunity is really, not necessarily having to be like the be all end all, but the opportunity here is to add another tool to your tool belt. For those of you that are here, I know that, different levels of real estate experience. Some of you may be just starting or wanting to get into real estate. Some of you are longtime veterans. This is one of those tools that fits for everybody. There's a different opportunity for everybody. And so I'm really, really excited to share a little bit more about what that could look like for you today, and what that could look like as you are looking to build your real estate portfolio and build generational wealth. So a little bit about me. You're probably wondering, who in the world is this guy? So I'm Paul Can. I'm a sales director at MDLQ. So myself and my business partners, we have been in real estate for over 35 years collectively, and we specialize from everything in tax deeds, pre-foreclosures, creative financing, wholesaling, quick flips, you name it. We probably have some experience having done it. So a really deep breadth of experience amongst our executive team. And that really was kind of the pinnacle of when we were coming together and thinking about what we wanted to do, what we wanted to create that would be different than what's out there. We really brought all of that industry experience to really question what is out there right now, and how can we create something that would be a game changer, something that would be disruptive, something that would really break down the doors for more people to get into real estate. So before I get into what exactly that is, I want to tell you all a bit about two guys. Story about two different guys. So these two guys together have created over $2.4 million in software development. And the really interesting thing too is that they were able to also acquire a C-suite worth over $1 million to run the SaaS company. And all of this was done without any prior coding knowledge, any programming ability, or any prior experience within this industry. Now, the really great thing about this, please make sure you mute as well, everyone. Awesome. Thank you. And the really great thing is that they took this experience and created an automated real estate funding program and delivered over $2 million in funding in a few short months. And all of this, as impressive as it sounds, was done with no money out of pocket. So you're probably wondering, how in the world is this possible? Who are these guys, and how could they have built this with no money out of pocket? Well, those two guys, that is Carlton and Tehran, are founders at MDLQ. And the really great thing about Carlton and Tehran is their mindset, the mindset that they brought into the different businesses that they built and what they've brought into building deed funds. We wanted to create something different around not just another funding company, not just another funding resource, but we're here to really change people's lives. And we're bringing in the opportunity of shifting those that are, thinking from kind of like a certain paradigm around what it takes to create wealth, what it takes to build a business, to moving it into a new paradigm of creating new possibilities that every single person can step into as long as they're given the right tools. And that's what we set out to create. So what they brought into MDLQ, what they brought into those businesses, is Robert Kiyosaki's cash flow quadrant. Who here has heard of that? Rich Dad, Poor Dad, the book. Yeah, many of us have heard of that. Many of you have heard of that. Of course, classic book in terms of Rich Dad, Poor Dad. The cash flow quadrant really illustrates the different mindsets between, depending on what quadrant you're in. So I want to talk a little bit about that. Now, the quadrant, if you are not familiar with it, I just want to share a little bit about it. If you are, just a little bit of a review, bear with me. So the quadrant is split into 4 different sides. So there's the E, which is employee, so working for somebody. And then there's self-employed, or sole proprietorship is another way to look at it. Then on the right side, you have B, which is big business. Big businesses that create a system to also run their businesses. And then you have I, the investor. So here's the misconception often, is that you have to be in a certain quadrant in order to make money. And that's not true, because you can become rich in any one of these quadrants. There are employees that make a ton of money. There are people that are self-employed and sole proprietors that make a ton of money. Big businesses, investors, all of them have this can have the opportunity to make an incredible amount of money and become rich. So it's not actually about the outcome around making money. So if it's not about that, what is it really about? What is the difference between the two sides? The difference is how you go about making your money. And the difference for the left quadrant for the employees and the self-employed is they trade time for money. So time is the most important commodity, and they're trading their time for money. So they are kind of the central piece, right, to the puzzle, because their time is required in order to generate income. Now, the difference is on the right side is that they use money to generate more money, or they often use, a lot of investors, somebody else's money to generate more money. But either way, as you can see, it multiplies without the most important aspect there for them, which is time. So we all have 24 hours, in a day, right? And 7 days in a week. So how do we maximize what we create within that time? How do you, a lot of people talk about making money in my sleep. How do you create a business? How do you create a system so that your money can work for you and you're not working for your money? Now, the difference between these two is also a mindset from a mindset perspective. So you have the wholesaler mindset on one perspective, and you have the investor mindset on one perspective. Now, don't get me wrong. There's a lot of wholesalers that you can make an incredible amount of money wholesaling. That is absolutely, not in terms of a limiter at all. The thing, though, you got to think about is that you got to trade your time for the money, right? You're knocking on doors, you're putting up the bandit signs, right? You're talking to different sellers, getting on the phone over and over and over until you get a yes and you get that particular property under contract. And then, of course, you're flipping the contract. Now, that is definitely one way to do it. And at the same time, you're trading time for money. Now, on the other side, for those that are looking to become on the investor side, where they're using maybe someone else's money, or they want to leverage their time to make more money, that is the difference between the two. So today we are talking about the right side for those that are interested in shifting to the right side, or playing in a bit of both, or possibly maybe learning a bit more information around what could that possibly look like in terms of what is deed funding, or what could that look like from an investor standpoint of what this could provide for me. So if that is something that you're thinking about, so either shifting from wholesaling to investor, or being able to play in both sides, or learning more information about how we can add another tool to your tool belt, this is the workshop for you. This is the people that I want to talk to. Now, this may not be for you if you are looking at, hey, I want to stay in wholesaling. That's the only thing I want to do, and I don't want to do it any other way. There's absolutely nothing wrong with that, and that's okay. And just as a caveat, this might not be the workshop for you, and that's okay. So with that said, what if you can invest in a property with little to no money out of pocket? I'm curious who would be interested in that. Who would that be a game changer for, where they can get into properties with little to no money out of pocket? Yeah, I see a lot of hands up. Awesome across the board. And so here's the thing, is that currently this is the biggest barrier to people getting into real estate and also continuing to scale their portfolio of real estate is capital and access to capital. So this is what we're going to learn today. And these are the 3 things that you can walk away with by the end of the presentation. So number 1, you're going to learn about how to get into properties with no money down. And you heard that right, no money down. Second is how we can get funding without credit or income requirements. And number 3 is how you can leverage your current properties, if you do have a current portfolio of properties, and your cash to go further. So with that said, let's jump into it. So I want to tell you a little bit about what deed funding is, because it's a new concept. It's also kind of a new term, not really heard about in terms of what deed funding is. So what exactly is it? So I want you to think of a title max. Who here is familiar with title max, like in terms of how it works or how it operates? Anyone's worked with a title max or familiar with it? Yes, no. Okay. So what a title max is, how it works, is title max usually works for things like cars. I'm going to use that as an example. So say you have a car, your car has a title. So you drive up to title max and you bring in your title. So they fund you against your title, you take the money and you drive away. Now, when you come back, you pay off the money and of course, any kind of interest owed, you get your title back, you drive away. Now, say you never show up ever again, you disappear off the face of the earth, you don't ever come back with the money, they keep your title. It's as simple as that. And that is exactly what deed funding is. So it's a very similar concept. We took that and we placed it into the arena of real estate. So what is the difference between deed funding and kind of what is already out there from a conventional financing or even non-conventional when you think about hard money perspective? So number one, it is not for consumers. What does that mean? It is not for the average consumer that is looking to purchase properties to live in. So your average consumer that is, going and looking on Zillow, looking to purchase something for a primary residence standpoint to live in, this is not for that. This works the best and works really, really well with the type of properties that investors would want to look at. So you'll think about distressed properties. So you think about discounted properties, properties that you're getting for pennies on the dollar. This is the type of investor that that deed funds works really well for. And this is the type of investor that we want to speak to about deed funds. Now, second thing, it is not a loan. A lot of times when you're going to conventional financing, it works from the perspective of a borrower perspective and a loan. So a borrower and borrowing perspective. So the difference between the two. Oh, if you just came in, please mute. Thank you. Awesome. So the perspective is that we are not loaning you the money, because what we're doing is we're going to come in as capital partners and we're going to purchase the property on your behalf. And you're probably wondering, how in the world does that work? Well, let me tell you a little bit more about what that would look like. So first of all, there's two different tracks. There's the purchasing track and there's the currently owned properties track. So I'm going to start with the purchasing side. Purchasing applies to properties that you do not currently own. So you are looking to purchase this particular property. Now, in this track, the great thing about deed funds is that you can get into properties by leveraging the current cash flow that you already have. So cash flow that you usually would tie up and say a down payment, now you can have that go a lot further. And you can also get game-changing access that you wouldn't have otherwise, just because a lot of times, income and credit is the number one reason why people don't get access to funding and capital. So both of those out the door. So you have the opportunity to get access here. Now, on the second track on the right side is currently owned properties. So that is for those that already have a portfolio of properties that they are managing, that they own. So in this particular track, you have the opportunity to leverage and scale. So you have the opportunity to leverage what you currently own and then scale it faster so that you can grow faster and go further. So currently, for those of you that are, very, very familiar, because all of you have, I've been in real estate in some way, shape, or form. This is the current real estate process. So I'm not going to drain it too much. So you're going in, you are finding the property, you negotiate the price, then you are going and getting financing approved through certain requirements. Now, I don't know for all of you, for me, I recently bought a home and it is a lot of paperwork. Like you are submitting PDFs and you got to scan in all your documents, et cetera, pages and pages of different things that you got to prove before they finally give you the final okay. So there is the whole financing approval process. Then finally, you got to pay your down payment and then you obtain the loan, you purchase the property and you do whatever you want to do with it afterwards. So in this particular situation, the how it works, of course, is that because you're obtaining a loan, you have a lien on the property. And also it's going to affect your income to debt ratio as well, because you are, of course, taking out a loan based off of probably your credit score or your income or different kind of requirements that you would meet. Now, what is the difference between that and the deed funding purchasing process? This is what it looks like with deed funding. This is the new purchasing process. So it's still similar in the perspective of you're still finding the property, you're still negotiating the price. Now, the difference is instead of submitting all of your personal information, you are going to submit the property information for funding. And it's a very, very simple application process, literally one form that you fill out. And mostly information that you put down pertains to the property value itself, not so much about your history and your background, et cetera, et cetera. So then what happens is the capital partner or funding partner comes in and purchases the property on your behalf. And at the same time, a buyback and lease agreement is signed. So what does that mean? It means that within the time frame that you choose, you have the exclusive right to not only buy back the property yourself during the term or at the end of the term, You can also do whatever you like to the property. So you want to fix it up, you want to rent it out, you want to, have it vacant. It's completely up to you what you want to do with it if you want to hold it. So at the very end of the term or before the term, you can either buy it back yourself or you can sell it for profit. Now, the really great thing is that when you sell it for profit, the only amount that we obtain back is the funding amount. Everything over and above that, the profit is 100% yours to keep. We don't take a single dollar of the profit. So whatever it is that you are selling it for, that you get that spread, aside from the amount of funding that you obtained, you keep 100% of that. So that is for purchase. Now, for currently owned properties, still very similar, but a couple of nuances that are different. So one is that instead of submitting the property that you're looking to purchase, you're submitting the currently owned property for funding. So that's the information that we are looking to obtain in the application. Then same process. The title is transferred to the capital partner. Then you'll receive funding, and you can use that funding to do whatever you like. So if you want to fund one property, you want to fund multiple other projects and properties, you can go ahead and do that. Then same thing during the term or by the end of the term, you have the exclusive opportunity to buy back the property, maybe using profits from other projects that you're working on. Or, if you're like, hey, I was looking to sell it anyways, you can sell it off to the market for profit. And same thing, the only amount we obtain back is the funding. Everything else over and above that, you keep. So what is the benefits of deed funding compared to, other conventional or even non-conventional financing options? Number one, there's a low monthly interest rate. Number two is the fundee. So you select the term, and the term is up to 18 months. So as you can see, this is meant to be a creative bridge funding. It is not the same option as mortgages out there or those types of kind of long-term financing. It's meant to be short-term. It's meant to be that bridge, to either buy you time or give you the opportunity to be able to take advantage of properties that come up. And instead of having to wait for them and get approval, you can really jump in quite quickly. Number four, there's no prepayment penalty. So you can, if you want to pay it back earlier, if you want to buy it back earlier, you can completely do that without any penalty. We fund in as little as 3 weeks. You can also have the opportunity to defer your closing costs as well, which means that you may possibly not even have to pay a single penny out of pocket at closing, all the way until you get your profits at the very end. So also no credit is required and no income is required. So I want to pause there before we kind of talk a little bit about rates and terms. I know there was a ton of information, so I just want to quickly pause there to see if there's any questions just around what I shared around deed funding and what it is and how it works. Any questions? You can come off mute or in the chat as well.
Yeah, I did have a question, Paul. How you doing? This is Stan.
Hi, Stan.
Hi. And thank you for this as well.
Absolutely.
When you talked about the buyback lease agreement signed and all like that, so you just go over that one more time, because I'm like, okay, when you buy back, what's the price? So you're saying whatever that price is, all that that would be owed back is what you borrowed originally, and then the rest would go back to you. So
yes, yeah, great question. So in terms of the buyback process, I'll explain a little bit about that. So when you initially close on the property, so close as in the capital partner comes in, purchases the property on your behalf, they close it, so the title is transferred to the capital partner. You sign a buyback and lease agreement simultaneously, which gives you the exclusive rights to do whatever you want with the property during the terms. Now, when you asked about, how much do I buy it back for? Great question. The only amount that as the capital partners we would obtain back is the amount of funding that you obtained in the first place. So say if it was $200,000 in funding, that's the only amount that you would need to buy it back for. Now, if you want to sell the property, you determine the price. So it's completely up to you how much you want to, put it out for. We work with you. So you're like, hey, I know I obtained the property for $200,000. I want to sell it for $300,000. Amazing. go ahead. You can work with a realtor, or if you want to sell it yourself, put it out on the market, sell it for 300,000. The only amount that you gotta, in terms of that we obtain back would be the 200,000, and the extra 100,000 spread that you gain from that particular property, you keep. Does that answer your question?
Yes, yes. Now, what about HUD houses, HUD homes? Can Would this work with HUD homes if I was to get something through HUD? And
tell me a little
yeah.
bit more about that in terms of what you'd be looking to do with the HUD homes.
I mean, if I was to acquire or line up a home through HUD, and would you finance that, and then I can go ahead and turn around and put that on the market?
Yeah. So, in terms of, so the number one thing that is always is kind of the common denominator, no matter where you are obtaining the property, is that the capital partner has to be able to have the title transferred to them. So as long as that you can do that, like whether it is through HUD or whatever it is, as long as you're able to transfer the title to the capital partner, then it works. And then afterwards, if you want to flip it right after, you can totally do
that. Okay, thank you.
Yeah, no problem. No problem. Destiny, can you hear me properly? Or was it just, I know Stanley was a bit choppy, but can you hear me properly? Does it sound okay? Yes. Okay, perfect. Might have just been a little bit of a connection issue. Any other questions before I jump to the next part? Yes, no, nope. I'm taking that as a no. Okay, we'll have another opportunity afterwards and I'll come back if questions come up a little bit later. Okay, all right, I'm gonna keep going. All right, so let's talk about rates and terms. You're probably wondering, okay, what does this all look like? So I'm gonna start with purchasing first. So for purchasing, just as kind of a quick review of that, purchasing is you don't currently own the property, you're just looking to purchase a property. So in purchasing, deferring monthly payments is not an option here. The asset types that work is traditional real estate. So commercial, land, residential, that all works. Now we fund up to 60% of the as is value. Now I want to pause here. As you saw, what we talk about here that is a bit different than what most people are used to, especially from a conventional or even, hard money lending standpoint, is a lot of times they're looking at ARV or LTV. Here we are looking at as is value, which means if today that home was put on the market and there was not a single thing that was done to that home, what is it worth? And we fund up to 60% of that. So often the question I get is, okay, Paul, so I got to bring 40% to the table then. Is that what you're telling me? Well, here's the answer to that is it depends. It depends because as you notice here, we don't fund according to the purchase price. So it really depends on how your deal is structured, because as I mentioned earlier, the type of deals, and not that you can't, in terms of if you want to purchase a home at as market value, that's completely up to you. But in terms of the type of properties that we usually work with and works best with deed funds are distressed properties or discounted properties. So you're getting those properties often for 40 cents on the dollar, 50 cents on the dollar, 60 cents on the dollar, which you should, because investors, when you are looking to, put it back on the market, are probably not looking to purchase a property more than 70 cents on the dollar, as an investor, if you're looking to resell it. So, or flip it, right? So you want to look at, giving yourself a spread as well. So it really depends on how you structure the deal, because if you get a property, for example, 40 cents on the dollar, 50 cents on the dollar, we still fund up to 60%. You can still get funding up to 60%. Now, you're playing with house money, right? Now you may maybe have that go towards renovations. Maybe you can have that go towards debt servicing. Or if you have the property that is, 60 cents on the dollar, it funds 100% of that particular purchase. So I want to clarify that piece because it's a little bit different than, conventionally what we're used to talking about, which is more of an ARV, kind of like after repair value. But this one focuses on the as is value of what the property is worth today. So in terms of the term itself, you pick the term, and there's 3 tiers of terms: 0 to 6, 7 to 12, 13, all the way up to 18. I'm not going to talk about the specific rates here, just because the rates, just like, all of you are used to from a mortgage perspective, right? Working with different financing kind of companies, it fluctuates every single day. So once you put in your application, you will get the rate that that is available for you in the term sheet that will be sent directly from the funder. So you will have all that information. It's not like you're going to sign up for stuff and then you're not going to know what you're getting into. So you're going to get all that information. If it looks good, then you proceed forward. So the application process, is passed through to the funder, and then they'll provide all that information. Now, you also have the option to finance your closing expenses up to 12 months. So that means that you can defer your closing costs all the way until the end of the term that you select. So, maybe you're looking to use when you sell it off for profits, using the profits to pay for the closing expenses, so it doesn't, tie up your cash flow today. So there is definitely that option there. Now, if you're looking at currently owned properties, so you currently own these properties, they're in your portfolio, you have 2 different options. One is deferred monthly payments. That means that you don't pay anything out of pocket. You are not paying any monthly payments all the way until the end of the term. Now, in the specific scenario, we will fund up to 50% of the as-is value, and the term is up to 12 months. So a little bit of a shorter term just because of the risk that's involved here. So same thing, you do have the option to finance your closing expenses as well. So if it works well for you, you have the option to not pay a single penny all the way until the end when you're looking to use your profits to, pay back the monthly payments, to pay back the closing expenses, but you didn't have to tie up your cash flow, didn't have to pay anything out of pocket in the meantime during the term. Now, if you're looking to, you're like, not looking to defer my monthly payments, we have another track for that as well. So with that, the 2 asset types in this particular scenario for currently owned applies not only just traditional real estate, but tax deeds as well. I'm going to explain a little bit about what that means. Now, we fund up to, in this scenario, 65% of the as-is market value. Same thing in terms of terms as purchasing. So, starts 0 to 6, goes all the way up to 18. You also have the option to defer your closing expenses as well for 12 months. Now, I want to talk a little bit about tax deeds. With tax deeds, a very, very interesting situation. It's also kind of unique in that with tax deeds, a lot of times, I'm going to use Georgia as an example. You're going to go to the auction, you purchase a tax deed. Now, with that tax deed, often you have to sit on the tax deed until its redemption period. Might be 6 months down the road. In Georgia, it's a year down the road, right? Then you get your the redemption. After the redemption period, you get a percentage, kind of interest payment plus your money back, or you get the property, right? But in the time being, please make sure you mute. In the time being, you're sitting on that money. You paid it, you're tied it up, you can't do anything else with it. Now, with this particular scenario with deed funds, you can actually take your tax deed, and with the tax deed, we're going to look at 2 things. We're going to look at either the 65% of your as-is value or your purchase price, and whichever one is lower, the lower of the 2, is the amount of funding that you'll get. So in this, for a particular example, say of 180,000 in terms of the property's worth 180,000, you bought it for 100,000 at the auction. Well, 65% would be $117,000. So that would be one number we consider, and the other one is $100,000. The lower of the 2 is $100,000. So in this scenario, you would actually get 100% of the amount that you put into the tax deed. So the $100,000 in funding, you can take that $100,000 and go buy another tax deed, or you can go invest in another property. It's completely up to you. So instead of tying up your cash flow, you now have the opportunity during that year to be able to invest in something else and take your money elsewhere and continue to, you can actually do that over and over. I think it's about 7 times that you can continue to do that. So there's a real opportunity to leverage what you have and go further with it. So with that said, we're very upfront with the fees involved as well. You're probably wondering, okay, like what does that look like from a fee structure perspective? So number one, to apply doesn't cost any money. So you can apply in terms of submitting your property for funding. There's no fee there. Once you get your term sheet back, you will look at the terms, and if the terms look good to you, you sign it. Then there's an application fee of $40, but there's nothing before that. Now, everything else will be closing costs. So it's pretty average in terms of what you see, pretty typical. So, your transfer taxes, you have your closing expenses, the documentation preparation costs. We also have a collateral review fee of $500 per asset. Now, I want to explain a little bit about this. So reason why there's a collateral review fee, and if, for example, the due diligence comes back, because there's a due diligence process after the term sheet is signed, so it goes into underwriting. The main thing is to confirm the property that you submitted is the property that is still standing, it's not burnt to a crisp or something like that. So in the event that, say, it is burnt to a crisp but it's no longer standing, of course the funding amount is going to change, or possibly the funding might fall through. Now, in that particular scenario, the fundee is still responsible for the $500 collateral review fee. Now, why is that? Number one, we want to make sure that all of the properties that are submitted are quality properties. It's not just people throwing spaghetti up against a wall and kind of seeing what sticks. We want to make sure that they're quality properties coming through the door, and we want to make sure that there's skin in the game for everybody involved, so that whatever you want to get funding for, it's actually a property that you want to follow through with, that you really want to invest into, and you've done your due diligence as well from a fundee standpoint. So that's what the collateral review fee is. Now, there's also an origination fee of 4% as well that's due at closing. And of course, any other kind of transactional miscellaneous related costs as well. So with that said, what can I use this for? So land, commercial, residential, all those types of properties are accepted. You can use this for a variety of different types of properties. So fix and flips, tax deleveraging, like I talked about, equity cash out, wholesalers that want to fund their own deals, short-term rentals, vacation rentals, RV parks, self-storage. What you can think of, we can do. It's really, really versatile from that standpoint. And so there's a lot that you can do with tax deeds. Now, I want to share with you something. This is the part that actually makes me most excited about deed funds. That makes it very different than what's out there. Is there is an opportunity, if you structure the deal the right way, that you can get into properties with no money out of pocket, which is what I talked to you at the very, very beginning. So what in the world does that look like? So say the as is in this illustration, the property value is $400,000. Okay. 60% funding of that is $240,000. Now, in this particular scenario, we're illustrating it at 1% of interest rates, 1% monthly. So in 6 months with deferred closing costs, that'd be about $2,600 and $2,640, call it, per month. Now, if you calculate that in the totality of, say, a 6-month term, that's about just over $15,000. So $15,000, $840. Now, if you purchase it here in this scenario at 50 cents on the dollar, so that's a $200,000 purchase price. If you look at that, you're still getting the 60% funding. So you still have $40,000 that left over. So what do you do with that? Now, with the $40,000, you can see you can account for the $15,000 in debt servicing. So the monthly interest rate that you got to pay. Once you account for that, you still have $24,000 left over to fund your fix. So in that entire project, there is $0 that came out of your pocket. And this is the part that makes me the most excited, because a lot of times when you think about properties, you're thinking about, how can I get the capital, even out of pocket? Maybe I need the money for renovations, et cetera, et cetera. Now, here's the really great thing is that with deed funds, like I said at the beginning, it might not be the ultimate solution for every property, but for the right property, when you find the right structure and you structure it properly, it can absolutely work amazing for you. And this is a perfect way to illustrate that in terms of being able to get into the properties that you don't have to put anything out of pocket for, which is an absolute game changer. So that's the part that makes me the most excited, when I look at the possibilities of what deed funding can do. So with that said, who is deed funds not for? So it is not for consumers. What do I mean by that? We cannot use primary residence as collateral. So that's the only thing. We can't use primary residence as collateral. Now, consumers, once again, are those that are regular home buyers. They're just looking to purchase a home with the intention of making it their primary residence. So this is not for that. Now, who is it for? This is great for wholesalers. It's great for investors. It's great for mortgage brokers. It's great for those that are looking to invest in the real estate industry, or looking to invest in properties and projects. This works great for. And the entire process is very, very simple. Like I explained to you at the very beginning, you complete an application, which is basically a one form application. The funder will review your application. You'll get a term sheet back, usually within around 48 hours. You'll review it, you sign it, then the funder is going to begin their due diligence. And that's where they're going to go and they're going to look at the property. And then you, as the fundee, you will select the title company, and then we close in as fast as 3 weeks. And that's pretty much it. Incredibly simple process. So with that said, I want to pause there because I know I went through a lot of information, and I just want to pause to see if there's any questions around deed funds, around the details of it, or anything that kind of came up for you.
Hi, Paul. Got another question.
Hi, Stanley. Yes, not a problem.
Okay, and I don't know if you can hear me clearly. I don't know. I just switched my my microphone. I'm hoping that works.
Okay,
but,
awesome. It's still cutting out a tiny bit, but you're okay right now. Go ahead.
Okay. The collateral review fee for are you doing that for the tax deeds as well?
Yes, yeah, it's part of the underwriting process, because even with tax deeds, they're going to have to look into the property and make sure it is what you're saying it is. Basically, is why we review.
And you're looking at the value of the home, not the value of the deed.
Correct. Yeah, the value of the deed we consider as a part of the amount of funding that is available for you, because we either give you your up to your funding amount, or up to 65% of the as-is value. So that's the only time that we're really looking at in terms of the value of the tax deed from the perspective of what you paid for. But overall, they're evaluating the value of the home itself, or the property itself, when it goes into underwriting.
Okay, so I can't use this to buy my first tax deed. This is going to assist me in getting my second and third and so forth.
Correct. Yeah, from that perspective, yes, because we would be considering this for tax deeds as currently owned. So yeah, you would need to purchase a tax deed, then you can utilize deed funds from that perspective to kind of obtain that funding to get into your next properties.
And is there a special consideration for land if you're just buying the land?
Nope. Land, commercial, residential, all of that works. So.
Okay. Thank you.
Awesome. Absolutely. Great question. Aileen asked, how many deed funding can you do per year? Great question. So the way that it works is, think of it from a perspective of almost like a line of credit. It's not a line of credit, but think of it with the structure of a line of credit. So every single fundee gets a maximum of $500,000 in funding that you can obtain at one time. Now, what exactly does that mean? The $500,000 means that after you pay off that property or buy back that property, it's almost like clearing it off your credit card or clearing off your line of credit. So that will open up for you again to, get into more investments. So from your the vantage point of your question, to answer your question, the faster you go through your contracts, so the faster you either buy back or, sell off the property, the more properties you can get into. So it's not so much about the number of properties, it's about kind of the maximum you can get into at one time. But once you clear a certain contract or multiple contracts together, that amount, you can think about it as like credit that goes back to you, that opens up for you to use again. Does that answer your question, Aileen? Yes. Yes. Okay. If not, you can type again in the chat for. Okay. Awesome. Great. Any other questions?
So then you would have to be buying the tax deed towards the end of any redemption time, so that next phase would be actually taking possession.
Not necessarily, because with the tax deed, you have, I'm just going to use Georgia as an example, but every state is a little bit different with its like redemption period. So for example, in Georgia, you have the whole year, right? So in the year, you would have to, you would have the whole year to basically, wait until you can redeem it at the very end. But at the same time, you don't necessarily need to purchase it, no, sorry, get deed funding at the end of it, because you technically can still get the full 12 months in term if you want to select the full term. So it really is up to you in terms of your particular strategy, but you don't necessarily have to have it towards closer to the redemption period. You can have it at the very beginning because you can still select 12 months, which would be the full term, until you would be able to redeem at the very end. Does that answer your question, Stanley?
Yeah,
Okay,
yeah, I think so.
perfect. Aaron, you had your hand up. You can go ahead and come off mute.
Yes, I just had one question.
Yep.
Does the funding work anywhere in the United States, or are there any restrictions?
Great question. Yeah. So in terms of funding, we fund every state except for New York and California. Main reasons for that is New York, there is the squatter loans. So, and the squatter laws as well, complex situation. So we don't, that's why we don't fund New York. And then we don't fund California as well, because we do have the maximum in terms of from a funding perspective. Like as I shared with you earlier, each person, your funding maximum is $500,000. Well, in California, most properties are kind of above that. So, at this particular time, it doesn't, kind of work within that threshold. But in terms of states that are currently open, and what do I mean by open? Open means that the minimum amount of funding that you can request is $50,000 per application. Notice I didn't say per property, per application. So you can have, multiple properties come together if it doesn't quite meet $50,000. The $50,000 minimum means that state is open, and that is Texas, Florida, Georgia, Maryland, Indiana, Ohio, and Mississippi. Now, the other states we will fund as well, but those states will need to be opened. And by opening, I mean that at one time there has to be a minimum of $500,000 in collective funding requested, which means it doesn't have to come from one property. It can be, it's actually going to be multiple properties. It can even be multiple individuals. So you have multiple people, you say that want to, say crack open Illinois. I'm just going to say Illinois. You can have 10 people come together. Everyone has a $50,000 funding deal that they're looking to get processed, and you can do that. So it doesn't have to come from just one person. Definitely isn't just required for one property. But once that is open, then it's the $50,000 minimum. So yeah, that's kind of what it looks like. Does that answer your question?
Yes, sir. Thank you.
Perfect. No problem, Aaron. Carlton, you want to say a couple things?
Hello, all. Thanks for having me, Paul. Yeah, I just wanted to talk a little bit about the tax deed question that that Stanley had in regards to the timing of the redemption period on the tax deed and the funding term. So with the tax deed, we know that it goes through a redemption process, and in Georgia specifically, 87% of those particular properties are never redeemed before that expiration period. So you end up with the property. So at that moment, the funders, since they have the tax deed, because it is essentially the title to the property, which is the collateral for the funding, when they take possession of that, they're going to make sure that whatever process need to be done are done. So if there's a process for insurance, I know there may be a question in someone's mind that, well, if I buy the property, who pays for the insurance? They have the title. So they're going to make sure the insurances are in place. Just like they have a redemption process that needs to happen, they're going to make sure that redemption process happens. If the redemption process happens and the term period hasn't expired, well, you still have your term for the funding component. It just converted from a tax deed to a non-warranty deed, right? So what they're doing is collateralizing an uninsurable deed by funding the tax deed, if that makes sense. So when it's time to convert it, they'll make sure it's converted, but your funding is still in place. You don't lose your funding because it's getting ready to convert documents or in title shift. But if it's redeemed at that moment, then you've already paid your interest. The buyback is the amount. The funding will come back from the homeowner, because they would have had to pay back. And in Georgia, it's 20% a year. So if it was 100,000, they have to bring back 120,000 if that's what you bid on the deed. Which is why the maximum funding on that will never exceed the deed amount, the tax deed amount that you paid at the auction. So they're just protecting that space. So they don't want to give you 120,000 when your tax deed's value is 100,000, because when it's redeemed for 100,000, it's going to be redeemed at 120,000. You would make zero. So they're avoiding that situation, if that makes any sense. I hope that answered your question.
Awesome. Yeah, thanks for clarifying that, Carlton. I love that you added to that. Carlton is our CEO, so one of the geniuses that I shared at the very beginning. So really happy that you're on here with us, Carlton. And of course, you got any questions? He is like our strategy master. Carlton has a ton of experience in real estate. So any kind of type of strategy questions, he is definitely the guy that is going to support you with that. And, later on as well, if we'll talk a little bit about if you want to get more involved, what that would look like. So a couple of questions here. What's the time period before you go into closing? So we close in as fast as 3 weeks. I say as fast as 3 weeks in that if there are no bumps, so there isn't any issues that come up during the process, a lot of times because you select the title company as well. So it's also dependent on that in terms of the title companies, or kind of like any hangups from that standpoint, or do they take a little bit longer? So it's as fast as 3 weeks with the kind of the call it asterisks of there isn't any issues that come up during the process. We got another question on I think it's Conchita. Hopefully I'm saying your name right. Please correct. Is that right? Okay, perfect. We found a few properties. How do I find buyers? And do we have to go where the property is to see the property? Okay. Who pays for utilities, water when you find the property? Great. So 3 great questions. So I'm going to answer them separately for you. So number one, say you found properties, and then where do you find buyers? So from that perspective, the deed funding part of it is more just funding the property. From the buyer perspective, there's many different places you can go to source buyers. So definitely, I know Facebook is a really great place. We have a lot of agents that go on Facebook groups. There's like thousands out there, depending on its state and area and, county related, or you need a certain type of wholesaling group per se, some that are cash buyers. So there's many kind of different places you can kind of go. We have some agents as well that just, they're looking at bandit signs that are, put on the lawns. They call them, they're like, oh, actually they happen to be not just selling, but they're buying as well. So lots of kind of different avenues you can go about doing that. And the really great thing too, and I'll talk about it a little bit later, is that within our agent group, we have quite a network of different people. So there are real estate agents there, there are people that have been in the industry for a really long time, lots of different resources. So there's definitely a community. If you decide to I'll talk a little bit about that afterwards. If you want to kind of get more involved within deed funding, lots of different, people that you can connect with to possibly even help you, JV on a particular project, but lots of different places you can look to find buyers. And in terms of going to see the property, you don't have to per se fly there yourself to see the property. We will ask, have you walked the property? But that doesn't necessarily you walking the property. It could be you hiring, say, a real estate agent in the area, paying them whatever, $50, $100, something like that. They're going to walk the property, take some pictures, go in, observe the property on your behalf. That still counts. We just want to make sure that, you are doing some due diligence. Doesn't necessarily mean you yourself have to, go to that property yourself. Just having somebody on your behalf still go in and inspect, make sure check out the roof, check out the foundation, all of like the key items, making sure that everything's, kind of in good standing, or if not, being able to, you know, record that because that'll be considered in the as is value kind of formulation. Now, who pays for the utilities and water when you find the property? So I'm assuming you're asking the question from the perspective of after it's closed and you have the buyback and lease option that's signed. So in that particular situation, since you have signed a buyback and lease agreement as well, it's basically, if you think about it, the property is then leased to you. So it is in your care. So if you decide to, say, rent out the property, they're paying rent to you. They're not paying rent to the funder. So you are the person that is now managing the property, and you will be in charge of that as well, in terms of from that perspective of, you know, the utilities and taking care of the property and all that kind of stuff. Does that answer your question, Conchita? Yes? Perfect. Awesome. Let's see. I'm just gonna see. You said little to no out of pocket. What situation would I have to come out of pocket? Do you need an LLC to invest in another state? Okay, great question. Okay, yeah. So all of this is predicated on the structure of the deal, because every single deal is different. So it really depends on how you structure the deal. Now, we have some people, for example, that want to purchase a property and they have some money in pocket. So as I mentioned earlier, say you're looking to purchase a property, fund up to 60% of the as-is value. Say for them, they really wanted to get this property and it's 70% of as-is value. Now, in that particular situation, you would have to bring kind of the remaining balance to the table to close the deal. So you can do that if you like. Obviously, you know, there is an opportunity, say, if you look for a property that fits within that, call it 60% of as-is value criteria, then you don't have to, you know, bring anything to the table from, you know, a purchasing standpoint. There's still, of course, the closing costs that you can defer as well to the very end. Or if you're getting into these properties and you need to renovate this particular property, depending on how you structure the deal, you know, it might be covered with the 60%. And if it's not covered, you might just, you know, need to have a little bit out of pocket to, you know, paint up the place, or, you know, if it needs further renovations, you know, pay for whatever that might look like. So that it kind of really depends on the negotiation part between you and the seller. So that's why having this number of like, okay, knowing that I got, you know, this particular kind of, call it box, how can I find the right deal that fits into this box? So, you know, when you're going and negotiating with the seller, a lot of times when we have, you know, our fundees go out and they're negotiating, they know that, okay, like the max I'm going to get is 60%. How can I negotiate so that I can fit what I need to fit into the box? So they're going in and they're starting at, say, like 40%, right? I'm going to negotiate at 40%, whatever. And then making sure that, hey, the max amount that I'm going to offer is 60%. So at least it covers the purchase price. I might just have to chip in a little bit with the closing costs. And hopefully, you know, it doesn't take too much renovation, maybe just a quick paint job that I can do myself. So does that answer your question, Rhonda?
Yes.
Yes, I think you said yes. You cut out a little bit, but I think you said yes. If not, you can let me know in the chat. You're just kind of I think connections is cutting out a little bit. Do you need an LLC to invest in another state? No, you can select if you want to you know, quote unquote borrow or receive funding through you as an individual or through your company. So that's completely up to you in terms of how you decide to structure that. Yeah, no LLC required. Do you provide proof of fund letters? Great question. We get this question a lot. So this is a big difference between one of the differences between us, the way deed funding works, and say going to a hard money lender or going to a, you know, call it conventional financing. Because in this particular situation, a lot of times where you're getting a proof of fund letter, it's kind of to verify, hey, like the funds are kind of on the other side so that I can sell the paper or that I can kind of get it under contract. In this particular situation, we are coming in and purchasing the property, and we're working with often distressed properties or discounted properties. So we don't provide a proof of funds because we're not lending any kind of money. And it is a full purchase. So we're coming in, purchasing that for cash. So it's a little bit of a different situation. So we don't provide proof of funds. Usually what we've seen is a purchase and sale agreement works, is really all that's really needed to kind of get the deal done. Does that answer your question, Stanley? Okay, perfect. Once we find a property, how do we get in touch to start the application process? Great question. So very, very simple. We have, and I'll provide the link for those of you that were referred here. Definitely go back to, I refer you back to get in touch with the agent that invited you to the workshop. If you found us somewhere else, I'll give you our website as well that you can go to. Very, very simple. You just go on our website, you click apply now, you go in, you fill in all the information for the property, boom, submit it. And then basically within about, call it 24, 48 hours, you're going to receive a term sheet back, or you're going to receive some sort of answer back if there's any kind of, revisions that need to be done, or further information that we need. We will reach out to you within that 24 to 48 hour time frame. And then once you get your term sheet, you sign the term sheet, then it gets sent to underwriting, and then you basically begin the process to get the property closed. All right. Any other questions about anything I covered or anything that's coming up? You're very welcome, Eileen. All right. No questions so far. Okay, great. I'm really curious so far, just kind of like show of hands, those of you that are on, or, you can do a digital hand as well, or maybe just in the chat. Who here, I'm just curious, just based on what I shared, you can see, yourself using this, or someone that can use this, kind of this might be a tool that might be helpful, or something that you might be kind of interested in. Okay, see a few hands up. Fantastic. Thumbs up. Great. Yeah, you can share in the chat as well in terms of like a yes. Just want to kind of get a gauge to see where everybody is, and raising your hand. Awesome. Great. So for those of you that are thinking, this might be something that you might be interested in, once again, definitely get in touch with the person that invited you here. But if not, you can definitely reach me as well, and I can definitely help answer your questions. Now, with that said, for those of you that are interested in, you're like, hey, I can definitely see myself using this, or someone that I know could definitely utilize this. We created a program around that. So what we wanted to do was, for those that are already, in the space like you are, right? You're already doing the work within the real estate space, maybe as a wholesaler or as an investor. What we were thinking was, how can we create something for you to make money while continuing to do what you do? Doesn't necessarily need to replace what you're doing, what you want to do. Of course it can if you want to, but how can we help you make more money already doing what you're doing? So we created a couple programs around that, an affiliate and an agent program. So what exactly does it look like? So there's the affiliate program. The affiliate program, what it basically is you are sharing the opportunity with other people. So you're basically just marketing it, sharing the link with people. And if they have any questions, you don't have to deal with any of those questions. We just kind of take it from there. We'll answer their questions. So you don't have to really deal with any of like the client fundy kind of back and forth relationship management. So all you're really doing is talking to people about it, sharing the opportunity, send them to the link, and then we take it from there. So as an affiliate, super, super low touch. What we have is a profit share program. So on every single deal that's closed, you get a 25% profit share on every deal that's closed. And the profit is based on the total profit of the deal, which is 1%. So say the funding, I'm just going to use, say $250,000 is the funding. So 1% of that is $2,500. So it'd be 25% of that $2,500. So that's kind of what it would look like. So this is the affiliate program. So once again, 25% profit share. Now, say if you're like, hey, is there anything where I can get more involved, or, I feel like I have a bit more time, or, I kind of feel like there's a lot of people that I'd like to share this with, and I want a bigger piece of the pie. So we have something for that as well. We have our agent program. The only difference between the agent program and the affiliate program, you're still as an agent, sharing the opportunity, basically marketing that the opportunity in terms of in your different networks. So sharing it with people. The only difference is that aside from that, after that, if they have questions or concerns or anything like that, you are going to be the one that's going to be answering those questions. So basically just, a lot of the client kind of back and forth, you'll be managing that piece. Now, once they apply and they submit all of the information and they get their term sheet back and they sign the term sheet, your responsibilities end there. So the funder takes over after the term sheet is signed, and that's it. You don't have to deal with any of the questioning or kind of the back and forth from there. So it's really, it's actually quite low touch. It's quite simple. So it's really just the upfront kind of getting the word out, and then, managing any questions all the way until the term sheet is signed. Now, with that said, with the agent program, we have a tiered system, and it starts at 45% profit share, goes all the way up to 65% profit share. So 25% of the as is value. So yeah, it's 25%. So for this, for example, it's based on the amount of funding. So if the funding, so not the as is value, but the funding on the deal, say is $250,000, right? So you have 1% of that is the profit on the deal, and you would get 45%, 55%, 65% of that 1%. So the 2,500, say if it was $250,000 in funding. So that's kind of what it would be based on. So it's more the funding on the deal, and not so much the as is value. So that's the agent program. Now, actually, I want to go back here and I want to say one thing. The really great thing about the agent program is that if you are also looking to be a fundee yourself, so you're like, I can see myself using this for, my own deals. You as an agent, you can process your own deals, which means that you can double dip, because you can process your deals and get a kickback, a profit share on your own investments that you're getting into, which is the really crazy part. Because I definitely don't know any financing program that is out there that is going to reward you for getting into your own investments. So every single investment, you're getting a kickback. Every single investment, you're getting money back on your own deal. So that's the really great thing about the agent program, is that you can double dip. You can either have people that, utilize deed funds through you, or you can utilize it yourself. So however you want to utilize deed funds, completely up to you. But either way, there is a win-win across the table for you. So as an agent, I talked a little bit about it before. The process, very, very simple. So you're really managing the deal upwards from an application perspective. You're really looking at it for accuracy. Then you're submitting the application. We're going to look over the application. It gets submitted to the funder. They get a term sheet back. Once they sign the term sheet, once again, the funder takes over and provides updates all the way till closing. You don't have to worry about that. Then you get paid 1 week after closing. So that's basically what it looks like. Very, very simple. You're really managing all the way until the term sheet is signed. Now, with that said, we wanted to create another win on top of that, because we want to encourage amazing people to continue to, bring other amazing people to the organization, so we can really continue to work with more amazing people. So for every agent and affiliate that you refer to MDLQ, you as the referrer will receive a 10% profit share on every single deal that your referral agent or affiliate closes for the lifetime that they're with MDLQ. So lifetime that they're with deed funds. So this is completely passive for you. When we're thinking about at the very beginning, we talked about kind of that, left side, right side mindset. This is that right side mindset of not only, having that tool in your tool belt for yourself, possibly as a fundee or sharing it with other people, but other people that you refer to the organization, every single time they're doing great work, you're just being rewarded for it. It doesn't impact them. It doesn't take away anything from them. This is in addition to, what they're already going to be receiving as an agent and affiliate, simply as a thank you, as a reward for, sharing an amazing opportunity with more people. So this is completely passive, a really great opportunity to really build, another income stream for yourself, if that is something that you're interested in. So with that said, we also have a fast start incentive. So your first 60 days as an agent, you receive an extra $100 bonus on every single deal that you close. So this is just in addition, a little bit of, kind of fuel and momentum to get you up on your feet in your first 60 days. And, we go through the training with you. We have office hours, we have strategy sessions, we have lots of different resources. So by no means are you going to just get thrown in there and kind of get good luck. You're going to get training. You have a great community around you that is there to support you, and lots of people there that you can really kind of tap into to support you on your investment journey as well. So I am going to pause there. Any questions just with the agent affiliate program that I just shared? Nope. Clear as mud. No questions. That might be a first. So I'm just looking here, definitely sharing this information. Great. Awesome. Yeah, Crystal, you can definitely share this as well with your friends for sure. Currently wholesaling in Baltimore. This sounds great. Great info for wholesalers. Currently wholesaling in Texas. Great. Fantastic. What state are you in? Let us know. Texas. Okay. Great. Awesome. Awesome. All right. Who here, I'm curious in terms of just after, sharing that, who might be interested in the affiliate or agent program? Like that might be something they're, they find interesting. Kind of got to get a quick gauge. Awesome, Aaron. Love it. Love it. Love it. Destiny as well. Great. Fantastic. Great. Carmelita. Awesome. Rhea. Fantastic. Fantastic. Awesome. Conchita as well. Great. Awesome. Awesome. Yeah. So Aileen, great. Lots of people are interested. I love that. So yeah, this is really, we built this with the intention of win, win, win. A winning product with deed funds that really is a game changer, I feel like, for people being able to get capital and access to real estate with really little or no money. And it's a win for those that want to get involved in the organization and, be able to get a bit of kickback maybe for themselves as well, or, build another income stream. And also a win if you want to share it with, other people that you feel like this could be a great opportunity for them. You can see them using it and being able to build a passive income stream, a passive pipeline for yourself as well. So with that said, if this is something that you are interested in, I'd encourage you to tap back in with the person that invited you to the call here. So check back in with them. And then they can help you get signed up, whether it is, a property that you're looking to get funding for, or you want to learn more about the agent or affiliate program that you want to sign up for. Definitely check back in with them so that they can help you get signed up. For those of you that, heard about us through the grapevine somewhere else and found us, if you have more questions, please do reach out to me. You can also go onto our website, which is deedfunds.com, and you can sign up as an agent or affiliate there, or you can sign up for funding there as well through the website. And if you got any questions, this is my contact information, and you can definitely feel free to reach out to me. Rhonda, I'm already an affiliate. Do I send my jot form as well as my landing page to 100%? Yes. So you don't send your jot form, just your landing page. So, Rhonda here brought up a great point. Once you are an agent or an affiliate with us, you get your own landing page. So you will send that landing page to other people, because if they apply for funding, it's going to be associated with you. It's personalized and customized to have your information on it. For people that want to become agents or an affiliate through you, through your referral, they can go to that same website. Just make sure that they put down your information as the referral so that we can track it. We can backtrack it. For those of you that are looking to just sign up, make sure you do put the person's name that referred you, so that we can track them as the referral as well. Great. Any other questions just around anything that I shared, deed funds, the program, anything like that? All righty. And I'm just going to put, my email in the chat, so you can definitely reach out to me if you have any questions, and happy to answer them and, provide more information. Great. Fantastic. Great. I'm really glad it was very informative, Aileen, and, look forward to hopefully seeing some of you guys join our team. I'm really excited. We're growing very, very quickly, which I'm very, very excited about. We have a really great community of people that are really out to help each other and support each other in their own endeavors. So it's really great, to be able to do it together.
Paul, I want to ask you something.
Yes, go ahead.
Do we have to join RIA in order to do defunding?
Do you have to join RIA? Is that the organization with Dr. Teresa Martin?
Yes.
Yes. No, they're separate. But if you were referred by Dr. Teresa, you can go through her link so that you sign up through her. Just make sure you put her down as the person that referred you. But I don't believe you have to be part of that in order to be a part of this.
Thank you.
You're welcome. Very welcome. Awesome. Well, if we have no more questions, then I'm going to let you go. Give you back 13 minutes of your time this evening. Thank you for taking the time to spend with me this evening. I really look forward to hopefully seeing all of you at Deed Funds or being able to work with you all. And if not, hopefully you learned something and we can cross paths in the future. So feel free to reach out to me, and yeah, look forward to hearing from all of you and working with all of you as well. All right, take care. Have a great night.
Good night.
Thank you very much.